All right, in this video, I'm going to reveal what you need to know about when buying a business partner. And if you're facing this situation right now, the decisions you make in the next few weeks could either save you hundreds of thousands of dollars or cost you everything you've worked so hard to build. I'm Santiago Cueto, a board-certified international business law expert and best-selling author. And in my 3 decades of practice, I've guided countless business owners through partner buyouts. I've seen deals that went smoothly and preserved relationships. And I've seen others that turned into legal nightmares that destroyed both the business and lifelong friendships. So stay with me, because by the end of this video, you'll understand the 5 critical steps you must take to execute a successful partner buyout, and the 3 biggest mistakes that could sink your deal, and the financing strategies that most business owners never consider. And I promise you, the valuation trap I'll reveal at the end could save you more money than you ever imagined. But first, let me tell you about 2 clients I had last year. Both were buying out their business partners in similar situations. One walked away with a clean exit and a thriving business. The other ended up in litigation for 18 months and nearly lost everything. The difference? Understanding these 5 critical steps. Here's step 1. Review your partnership agreement. This should be your starting point, but you'd be amazed how many people skip this step. Your partnership agreement is like your roadmap. It should outline the exact procedures for buyouts, valuation methods, and payment terms. If you have a solid agreement, it may specify whether you need to use a particular appraiser, what valuation method to use, and even the timeline for completing the buyout. This document supersedes state law unless the terms are unlawfully restrictive. But here's the problem. Many partnerships either don't have written agreements or they have poorly drafted ones that create more problems than they solve. Now, if your agreement is silent on buyouts or doesn't exist, you'll be operating under your state's default partnership laws, which may not align with what you want. The key lesson here: if you don't have a comprehensive partnership agreement with buyout provisions, get one drafted immediately, even if you're not planning a buyout right now. All right, here's step 2. Get an independent business valuation. This is where most buyout disputes begin, so listen carefully. You cannot have a fair buyout without an objective assessment of what the business is actually worth. And I mean truly independent, not your brother-in-law who's a CPA, but a qualified business appraiser that all parties agree to use. There are 3 main valuation approaches. There is asset-based, which looks at the net value of all business assets and liabilities. There's income-based, which uses methods like discounted cash flow to calculate the present value of future earnings. And market-based, which compares your business to similar companies that have recently sold. The valuation method is very important. For a tech company with significant intellectual property, an asset-based approach might severely undervalue the business. Now, for a manufacturing company with substantial equipment, it might be the most accurate. Now, here's a critical point. If the partners are at odds, you may each want to hire your own appraisers and then find common ground between their conclusions. Yes, it does cost more, but it's far cheaper than litigation. Now, here's step 3. Structure the legal documentation. You need 3 key documents: a buyout agreement, a non-compete agreement, and depending on your business structure, a partnership termination agreement. The buyout agreement must specify the purchase price, payment, schedule, and exactly how ownership will be transferred. It should address what happens to outstanding debts, who's responsible for pre-closing liabilities, and any ongoing obligations. Now, don't overlook the non-compete clause. The last thing you want is your departing partner starting a competing business across the street using all the relationships and knowledge they gained from your partnership. The agreement should also address what I call operational continuity. That is, customer notifications, vendor relationships, employee communications, and any regulatory filings required by your state. Remember, this isn't a DIY project. Both parties should have independent legal counsel to ensure their agreement protects their interests and complies with all applicable laws. Now, if you're finding this helpful, hit that like button and subscribe for more business law insights that protect your wealth. And make sure you stay until the end, because the financing mistake I'm about to reveal has destroyed more buyout deals than any other factor I'm discussing here. All right, here's step 4. Secure appropriate financing. Most business owners underestimate how challenging buyout financing can be. You have several options, each with distinct advantages and risks. Self-funding means paying the full amount out of pocket. It's clean and simple, but requires significant liquidity. Many business owners simply don't have hundreds of thousands of dollars sitting around in their personal accounts. Seller financing is often the most practical solution. Here, the departing partner acts as the lender, receiving payments over time with interest. This spreads the financial burden and often makes the deal possible when traditional financing isn't available. Bank loans or SBA loans designed specifically for partner buyouts can work, but lenders will require solid financial statements, personal guarantees, and often collateral. The SBA program is particularly useful because it's specifically designed for exactly these transactions. There's also what I called an earn-out arrangement, where the selling partner stays on as an employee and receives additional compensation tied to future business performance. This can work well when the departing partner's expertise is crucial to the business's success. The key is matching your financing structure to your specific situation. A cash-rich business might handle self-funding, but while a service business with a strong cash flow might be perfect for seller financing. All right, here's step 5. Execute the closing and update all records. The closing is where everything comes together, but it's also where small mistakes can create very big problems. You'll need to finalize all documents, transfer ownership interest, and update business registrations and licenses. And don't forget about the operational side. Notify customers, vendors, and employees about the change. Update bank signature cards, insurance policies, and any contracts where the departing partner was personally involved. Tax considerations are crucial here. The departing partner typically treats this as a sale of their partnership interest, which may qualify for a capital gains treatment. The remaining partners might be able to step up the basis of business assets under Section 754 of the tax code, which can provide significant future tax benefits. You'll also need to update your business's ownership structure in your accounting system and with any regulatory bodies. For example, if you're a limited partnership, you may need to file amendments with your state's Secretary of State. Now here's the critical part. Maintain detailed documentation of everything. This protects you if questions arise later and ensures you can take advantage of all available tax benefits. Now, here's that valuation trap I promised to reveal. The minority discount mistake. When valuing a departing partner's interest, many business owners assume you simply multiply the total business value by the ownership percentage, but that's wrong. A partner who owns 25% of a business doesn't have 25% of the control. Their interest is worth less than a pro rata share because they can't control major decisions like dividends, salaries, or business direction. This is called a minority discount, and it can reduce a partner's buyout value by 20 to 40%. However, this only applies to non-controlling interests. If you're buying out a 50-50 partner or someone with controlling interest, the discount may not apply or might even reverse into a control premium. Understanding these 5 steps could mean the difference between a successful transition and a legal nightmare that destroys your business. If you found this valuable, like this video and subscribe to my channel for more strategies that protect your business and preserves your wealth. Because when it comes to partner buyouts, what you don't know can cost you everything. See you in the next one.